Right now, somewhere in America, someone just drove off a dealership lot thinking they got a great deal. They negotiated the payment down. They feel good. What they don't know is they're already $23,000 underwater before they've made a single payment. My name is Marcus, and this video isn't about how people get into car payments. That video's already been made. This is about what happens after you sign, the trap door that opens the moment you drive home. Because here's the number nobody puts on a whiteboard for you. The difference between the car decisions most people make and the ones that actually make financial sense isn't $900 a month, it's $500,000 over your lifetime. I'm going to prove that with math so simple your dealership definitely doesn't want you to see it. Let's start with what the bank sees when you walk in, because once you understand that, everything about a car loan starts making a very different kind of sense. When a lender looks at your application, they are not thinking about whether you can afford this car. They are running a model with one single goal: maximize the total interest collected while keeping your default rate just low enough to stay profitable. That's it. That's the whole equation. You are not a customer to them. You are a revenue stream with a credit score attached. Here's a number that should genuinely bother you. On a 72-month auto loan at 7% interest on a $55,000 vehicle, the lender collects approximately $12,000 in pure interest over the life of that loan. Stretch it to 84 months, and that jumps past $14,000. The monthly payment barely moves, maybe $30 or $40 difference, but the lender just collected an extra $2,000 from you for doing absolutely nothing different. That's not an accident, that's the product. And here's the part that makes it even worse. Most lenders don't even hold your loan after they originate it. They bundle your loan with thousands of others and sell the whole package to investors as asset-backed securities. The moment that sale happens, your lender has zero financial stake in whether you can actually sustain those payments for 7 years. They already got paid. The risk got transferred. The incentive to carefully assess your long-term affordability essentially disappears the moment the ink dries on your contract. You are not just buying a truck when you finance a vehicle. You are becoming a financial instrument that gets passed between institutions. Your monthly payment becomes someone else's investment return, and the entire system works best for everyone involved, except you, when you stay in debt as long as possible. Now let's talk about what's actually happening to your money from the moment you drive off that lot, because this is where most people's understanding completely breaks down. From day one, you are almost certainly losing money faster than you are building any ownership stake in the vehicle. Everyone has heard that cars lose value the second you drive them off the lot, but most people don't understand what that actually means for their real financial position month by month. Here's how it actually breaks down. You buy a $62,000 truck. You put $5,000 down. You finance $57,000 over 72 months at 7% interest. Your payment comes out to roughly $975 a month. In month one of that $975, approximately $333 goes toward the actual loan balance. The remaining $662 is pure interest, gone forever the moment it leaves your account. And the truck itself? In that same month, it lost somewhere between $500 and $800 in market value just from being a month older in a month more used. So you paid $975. You gained $333 in equity, but the asset dropped $600 in value. Your actual financial position changed by negative $267. You made a full payment, and you were worse off than you were 30 days ago. This is what I call the equity illusion. The loan balance is going down, slowly, painfully slowly, but the value of the vehicle is falling faster than the balance drops, especially in those brutal first 3 years. You're running on a treadmill that's moving backward, and the belt is set just slow enough that you don't notice you're losing ground until it's too late. By year 2 or 3 of a 6 or 7 year loan, most people hit what I call peak negative equity. This is the moment where the gap between what you owe and what the vehicle is worth is at its absolute widest. You might owe $42,000 on a truck that a dealer will give you $32,000. That's a $10,000 hole. And here's the cruel twist. This is the exact moment most people start thinking about trading in. Because by year 2 or 3, the new model just dropped. The tech feels slightly dated. Your coworker just pulled up in something newer. The itch starts. And the dealership knows this. They bank on this. Their entire repeat business model depends on people trading in at precisely the moment the negative equity hole is deepest and most profitable to roll forward. Let me show you what this actually looks like when you follow one person through the full cycle. Someone buys a $48,000 SUV in 2022, nothing down, full 72-month loan at 6%. By 2025, 3 years in, they've made 36 payments totaling around $28,000. Their balance is down to roughly $32,000, but the SUV is now worth about $26,000 on the open market. They're $6,000 underwater. They go to trade in, the dealer offers $26,000. They're $6,000 short just to break even on a vehicle they've owned for 3 years and paid $28,000 toward. After 3 years and $28,000, they own nothing. But the dealer has a solution. Roll that $6,000 into the new loan. Nobody writes a check. The pain disappears into the paperwork. They drive off in a $68,000 truck, but the actual loan balance is $64,000 after the rollover. They are starting $6,000 behind before the odometer has moved a single mile. Do this cycle twice, which is completely normal, completely common, and the dealership absolutely counts on, and you're looking at someone who might have $15,000 to $20,000 of old debt buried inside their current car loan. They are actively paying for 2 or 3 vehicles they no longer own, folded inside the payment for the one they're driving right now. It's financial sediment. It just keeps building, layer by layer. And because it's invisible in the monthly payment number, nobody ever makes you look at it directly. Now I want to talk about something that almost nobody discusses when they talk about car payments, and that's what gap insurance actually tells you about the deal you just made. GAP stands for Guaranteed Asset Protection. The pitch sounds responsible. If your car gets totaled or stolen and the insurance payout is less than your loan balance, GAP covers the difference. Reasonable, right? But here's what I want you to actually hear. The fact that this product needs to exist is itself a massive red flag about the financial structure of the deal you're in. Think about it this way. If you buy a house and it burns down, your homeowner's insurance covers the value of the house. You don't need a separate policy to cover the gap between the payout and your mortgage balance, because houses don't lose 25% of their value the moment you move in. The entire reason gap insurance exists is because cars depreciate so catastrophically fast that standard insurance literally cannot cover what you owe. You are buying a product specifically designed to protect you from the consequences of buying the first product. The dealer will happily sell it to you, financed into the loan, of course, for anywhere from $400 to $1,500. The smart move, if you genuinely want the coverage, is to add it through your regular auto insurer for around $20 to $40 per year, but that comparison is never made explicit at the closing table because the finance manager presenting you a menu of add-ons at 7 p.m. on a Saturday is not trying to optimize your financial outcome. What I want you to take from this isn't just buy gap insurance cheap, it's bigger than that. Every single add-on product that gets presented at a car closing, the extended warranty, the gap insurance, the tire and wheel protection, the paint sealant, every one of those products exists because the core financial structure of buying a new depreciating vehicle on a long-term loan is fundamentally fragile. These products are damage control on a deal that was already working against you before you sat down. Now let's talk about the psychology that keeps this cycle spinning. Because this isn't just about money mechanics. There's a very specific mental trap that makes rational analysis almost impossible once you're inside it. Behavioral economists call it lifestyle inflation, the pattern where spending expands to match or exceed rising income. Car buying is one of the most aggressive drivers of lifestyle inflation in American consumer culture, but there's a specific mechanism inside it that I want to name directly. I call it the payment anchoring trap. Here's how it works. The first time you finance a car, maybe you're 24 years old, and you get approved for a $350 monthly payment. That number gets installed in your brain as what a car payment is. It's your baseline. It's normal. A few years later, you get a raise. Your income goes up. You You trade in, and the dealer says, with your income now, you qualify for up to $700 a month. In your brain, fully anchored to $350 as the reference point, here's $700 as headroom, as space you have the right to fill, as money you're leaving on the table if you don't use it. Nobody in that room is saying, you could keep your payment at $350 and invest the other $350 every month and be six figures richer in 10 years. That conversation doesn't happen at dealerships, but the "you qualify for more" conversation happens every single time, at every single income milestone for the rest of your life if you let it. The ratchet only clicks in one direction. Payment goes up with every life event. Got married? You need something safer and more spacious. Had kids? Now you definitely need the larger SUV. Got promoted? Your vehicle should reflect your success. Every milestone becomes a justification for a more expensive payment, and it almost never clicks back down. The people who actually break this cycle, and they exist, they're real, I've talked to them, almost always describe the same turning point. It's not a financial epiphany. It's not that they suddenly became math prodigies. It's that they stopped connecting their vehicle to their identity. The moment a car becomes just a tool to get from point A to point B rather than a statement about who they are, the whole psychology collapses, and the $800 truck payment starts looking like what it actually is. $800 a month you could be doing something very different with. Let me show you exactly how different. Take two people, same age, same income, same starting point. They each take home $5,500 a month. Person A does what most people do. New vehicle every 5 or 6 years, rolling negative equity each time, consistent $850 monthly payment throughout their working life. Full coverage insurance at $280 a month because they're always insuring an expensive vehicle. Over 30 years, their total transportation cost, payments, insurance, fuel, maintenance, lands somewhere between $400,000 and $500,000. At the end of those 30 years, they own a vehicle worth maybe $8,000. Person B buys reliable used vehicles every 5 or 6 years, paying cash or financing short-term at a much lower balance. Average monthly payment is $250. Insurance runs $140 a month because they're insuring a $15,000 car instead of a $60,000 one. They take the $740 monthly difference and put it into a basic index fund. Over 30 years at a conservative 8% annual return, that $740 a month becomes approximately $1 million. $1 million. Built entirely from the payment difference alone. Person A has a truck worth $8,000. Person B has a portfolio worth $1 million. That is the real cost hiding inside a normalized car payment. Not the payment itself, not even the interest. The actual cost is the compounding wealth you never built because the money was locked inside a machine that was losing value in your driveway every single day. And this math doesn't require a finance degree to understand. It doesn't require any sacrifice that feels dramatic in the moment. It just requires making one different decision, once, and then sticking to it. Here's what I want you to actually walk away with today. The car payment trap isn't a story about bad people making stupid choices. It is a meticulously engineered system backed by billions of dollars of behavioral research, specifically designed to make financially damaging decisions feel not just reasonable, but earned. You worked hard. You deserve this. You need reliable transportation. None of those are lies. They're half-truths wrapped around a financial structure that quietly extracts wealth from your life one payment at a time. The rollover cycle that buries old debt inside new loans, the equity illusion that makes every payment feel like progress while you're actually going backward, the gap insurance that signals the fragility of the deal before you've even left the lot, the payment anchoring trap that ratchets your spending up with every raise and never brings it back down, the securitization machine running behind the scenes that removes any real incentive for the lender to care about your long-term outcome. None of this is hidden. It's all in the paperwork, but it's designed to be invisible at exactly the moment you're most emotionally committed to saying yes. The single most powerful thing you can do after watching this video is run the full numbers before you ever set foot on a lot again. total cost of ownership over the complete loan term, the opportunity cost of that monthly payment compounded over time, your actual equity position it'd likely trade in, the real rollover balance you'd be carrying forward. 5 minutes of honest math before a car purchase can genuinely change the next 30 years of your financial life. That is not an exaggeration. The numbers I just showed you prove it. My name is Marcus. If this changed how you see car payments, subscribe because there is a lot more where this came from. Drop a comment telling me what your current car payment is. I want to see the real numbers out there. See you in the next one.